we'll be starting our 5 days back to school series on AQZ and related items. If you're already in the Telegram group, you would have seen this slide, and of course, you know what we want to cover. No need to waste so much time on this. So let's move on. All right, so basically, when you open a chart, depending on how you zoom it in or out, you would actually see, you either see in a compressed format, you either see things like this, like what you see on the chart, right? In fact, if you install your MT4 for desktop for the very first time, it comes in bars. The price action will be portrayed in bars and not candlesticks, and they look something like what you have on the screen, right? And if you expand it a little bit further, you have what you have on the lower side of the screen, where you can see the candles themselves, and then you know, be able to make decisions if you know how to read them. So basically, this is what a chart will look like, aside if you replace them with other types of representations like Renkos, bars, Ichimoku, Hekinashi, and the likes, or even lines. But these are the basic patterns you will see as a trader. Your duty as a trader is to make sense out of all of this, and it's when we make sense that we practically begin to make money, right? I can conclude that it will be very confusing for a newbie, right? So why do we need to study candlestick anatomy? Of course, if you notice the previous slide was basically candles, right? We're talking about candles here. And of course, above we have compressed candles. So why are we really talking about candlesticks anatomy? Now, candlesticks are a form of depicting the relationship between price and time. When you look at your chart, basically, what you have is a chart of price against time. So you go to your MT4, you basically see price to the right-hand side. There will be price, and beneath you have time. So you have dates and times and all of those things, right? So sentiments, and with this comes candlestick with different reactions are not the same, and you can't expect candlesticks to be the same if they actually depict a reaction, which actually determines what price will be per time. So when you put together the candlesticks, they now form what we call patterns. They form what we call patterns. And any serious discretionary trader, discretionary here, most of us here are discretionary traders. It's either you're either a discretionary trader or you are an automated trader, somebody who trades using robots. So people who trade using robots have a different mindset from discretionary traders. They have a completely different psychology of trading. But for discretionary trader, we depend on our discretion to go in and go out. And over time, you hear somebody like Prof saying you need to begin to think like, somebody who relies on automation to be able to trade well, because with discretion comes one of the major reasons why price move: fear, greed, and sentiments, right? So a very good discretionary trader will strive to understand the psychology behind the patterns, and will be trying to be able to spot them easily in the market. If our business as traders is to make money off the charts, it becomes imperative for us to actually understand what the chart is saying. And that's why you see a lot of people say indicators don't work. I don't believe indicators don't work. I just believe that most retail traders transfer the hard work of trying to understand the psychology behind the patterns or the psychology behind a candlestick. They try to transfer that hard work into an indicator or onto an indicator. So when an indicator says overbought, they simply, or oversold, they simply begin to buy, irrespective of the fact that the candlesticks, which is what actually depicts the relationship between price and time, is saying otherwise, right? So that is the major reason why indicators are wrong. And I will tell you the truth that the few professional traders I know, even the ones trading for banks, use indicators. So all those mumbo jumbo that indicators don't work is actually fallacy, right? They do work if you know how to use them properly. But of course, we're not discussing indicators here now, right? So let's move on. So this is very, very basic, yet several persons don't know this. So we'll start here, then we'll begin to get more complicated as we move on. So in the candlestick anatomy, just like the human anatomy, you need to understand how it works. So I'll start with a bullish candle. Of course, you should know that a bullish candle is a buy candle. We'll call it bullish. We'll call it long, all those terms. And a bullish candle means price is going upward. It simply means you started from beneath. So you have the open under, right? And take a candle as a tussle between people who are buying and people who are selling. So buying sentiment and selling sentiment. That is, for the purpose of this discourse, we would assume that that is what this candlestick represents, right? So when people are buying, it pushes up, and when people are selling, it pushes down. Then the net difference determines where price will go to, right? So down here we have the open of the bullish candle. And sometime along the lifespan of this candle, sellers outweighed the bullish people and pushed price all the way to this point. So this was the lowest point that price ever came to within the lifespan of this candle. And somehow when price hit this level, some buyers were here and they pushed price back up to this place where there were some sellers or taking of profits, and price eventually closed here. So for a bull candle, we start, the open is beneath, the close is above, then the wicks, we call this the shadow or the wicks. This is called the shadow or the wicks, depict where price had gotten to before. Many people try throwing away this part, but as we continue in this 5 days program, we discover that wicks are very, very important, because basically that is where the tussle was basically won. So sellers actually won at this point and push price down. Buyers won at this point and push price up, right? So by the time we dig deep and we try taking trades from the wicks, we'll basically just reduce our stop loss. And that will increase our lot size, get out of the trade early, or even make bigger wins. So this is it for bullish candles. A bearish candle is the opposite of bullish candle. It opens above and then goes down. Remember, this is a chart of price against time, basically, right? So for a bear candle, it opens above and sellers pushes it down. It closes here. This was the highest point it got to, and that was the action of buyers. And this was the lowest point it got to, action of sellers. I want you to note some key things I just made mention here before we move on. So even though this is a bullish candle, what we're saying is that there are sellers here and that there are buyers here, right? If price if sellers push price down, something happened here for price to tick off. And we call that buying pressure. So there are buyers at that low and there were sellers at that high. It will come in handy as we move on into the candlestick patterns themselves. All right, so I guess I'm done with this. Let's move on to the next part, right? So there's a particular PDF document, very, very popular. It's found almost everywhere on the internet. It's called the Candlestick Trading Bible. We'll be looking at it briefly, and then we'll go, if time permits us, within the short time we have for today, we'll go into the AQZ candlestick patterns. But I'll be introducing us to some few candlestick patterns. Some you know already, and some we'll get to discuss them better, right? The very first one is called the engulfing bar, right? It's called the engulfing bar. And when we say an engulfing bar, like in this case, is a bearish engulfing. And of course, you know, price prints from left to right. Price prints from left to right. So the bullish candle came first, and the bearish candle, which is the black candle, came later, right? Now you'd notice that this bullish candle is head and shoulder bigger than the bearish candle. You could basically put this bearish candle inside the bullish candle and it will consume it, right? Maybe twice, maybe thrice, right? So when you have a larger candle to the right, subsuming a smaller candle to the left, you have an engulfing candlestick pattern, right? You have an engulfing candlestick pattern. The bearish candle engulfed the bullish candle. The bearish candle engulfed the bullish candle. And when you see bearish engulfers, they are one of the most powerful candlestick patterns. Is a sign that sellers are in control, right? So buyers came in here, pushed price all the way up, and they even pushed price again up in this candlestick, and suddenly there were some sellers here, and sellers pushed the price all the way down. And it consumed all the buyers that were in the previous candle, means the whole buyers there have been consumed. Is a sign of strength for the bears. Now, I want this to sink deep in, because no matter the strategy you trade, and in case you trade indicators or something, and you see a bearish candlestick pattern, it's just wise to want to wait to see what will happen thereafter, because candlestick. Have a candlestick, a bearish engulfing candlestick is a take action now candlestick. It is a take action now candlestick. Of course, if you go to your chart, you'll find bearish engulfing candlesticks virtually everywhere. Does that mean we just obey them blindly? No. When we get deeper, we'll get to understand, right? But for now, let's just take this, right? So when you have a bearish engulfing candlestick pattern at certain points in your chart, then it's good to take. So let's say you trade support and resistance, and you've been able to draw your resistance up there, and you're able to drop your support. Let's say, for the purpose of illustration, this is what you trade, and price is approaching your support, right? Many times you have fear because you are not sure if the support will hold or if it will fail, right? One way you can, or let's take for a resistance, you are not sure if the resistance will hold or the resistance will fail. If you find a bearish engulfing candlestick pattern at your point of resistance, is a good indication that price has a heavy tendency to drop lower, right? So when you have a bearish engulfing candlestick pattern, is a take action now candlestick pattern. However, there are several ways you could trade it. The first way you could trade a bearish engulfing candlestick pattern is to enter immediately this candle closes. Note the word closes. You have to wait for the candle to close. So once this candle closes, you could take your sell instantly. Or a more conservative way is to wait for price to pull back to cover what I'll call the bridge, just so that we don't use that term many of us know, right? So that we cover the bridge, right? You wait for price to come back to the tip of this candle that was engulfed, and then you sell off from there. So two entries, two ways to trade the bearish engulfing candlestick pattern. You enter upon the close of the bearish engulfing, that is the engulfer, or you wait for price to pull back to the tip of the engulfed candle, and then you take your sell. That is one candlestick pattern. Of course, very close to that is the bullish engulfing bar, right? So if you trade stocks, you might see this kind of formation for a bullish engulfing, but in Forex, when we see something like this, we call it a gap, and I don't want to go into that now, but it basically looks something like this. This is a bullish engulfing candlestick pattern. Here you could see that the bullish candle is head and shoulders above the bearish candle. The bearish candle can basically find itself fit fully inside the bullish engulfing, the bullish engulfer, right? Again, remember, it's still two ways engulfing candlestick pattern, right? So we've discussed the engulfing, and the engulfing is twin, it is two-edged, is either bullish or bearish. We'll go to the next candlestick pattern, which we'll call the doji candlestick pattern, right? So a doji is basically an indecision candle, right? If you understand that a normal candlestick with a full body has buyers and sellers within, if that candle closes almost at the same spot point, when the open and the close are identical, not necessarily the same, identical either in ticks, pipettes, or few pips, we'll call it a doji, and it is an indecision candle, right? And when a candle is telling you that there is indecision in the market, it becomes is utter stupidity for the trader to want to pick a side, except if your strategy tells you to do so, right? So there are over 10 million traders in the world, over 10, and I'm not talking about institutions, I'm just talking about retail traders, over 10 million. And if you've been following us for a while, we have a very good analogy we use, that if Chelsea is playing Liverpool, there usually will be 11 players on both sides of the team, either side of the team. It's very difficult for anybody to predict back to back, right? Who is going to win in the derby match? Who is going to score? What time of the day it will happen, and all of that. And if you understand that trading Forex, you have about over $7 trillion exchange hands daily. If you're very rich Forex trader, an average retail Forex trader who claims to be very rich will have maybe at max $500,000 in their account, but most people have 500 and 200, and you understand what I mean, $500 and $200, right? So if the market is 7 trillion, it's utter stupidity to throw in your $1,000 when you find a candlestick telling you that we are not too sure what price will do. I mean, 10 million people and other big whales are not decided upon what price will do. Why should you want to reach your 200? Why should you? Right? So when you see a doji, is an indecision candle, ladies and gentlemen, is an indecision candle. When you find a doji around a resistance, I'm using support and resistance, even though that's not what we'll be trading, just so you could get it basically. So if you find a doji at your resistance, is an indication that price hasn't made up his mind, or perhaps the market forces haven't made up their mind. So when you find an indecision candle, it's best to just box out that candle, box it out, and wait to see what price will do. If price closes beneath the lower wick of that candle, then you can become bearish from your point of resistance, right? We'll see how all this fits into AQZ and why AQZ just makes trading simple, because it goes back to the very basics, candlesticks, the very, very basics, candlesticks, right? So again, doji is an indecision candle, indecision, right? All right, so we are going to leave out other forms of doji. There are other forms of doji, a dragonfly. This is one form of doji. Of course, again, it's a doji. It basically does not have body. So whether it is dragonfly or snake in the monkey shadow or whatever, we basically don't want to care. A doji is a doji. Be it a gravestone doji or an angelic doji, a doji is a doji, and let's move on, right? Now, we are going to leave out these other ones, a morning star and the likes. Why? Because, again, you don't actually need that. This is a bullish engulfing candlestick, right? Bullish engulfing. So just move ahead with your bullish engulfing, and let's move on. So let's leave out all of that. We'll go straight to the very, very important ones, the ones we need to actually do what we want with AQZ, right? The next candlestick pattern is a pin bar, right? It's also known as the hammer. And of course, it looks just like the hammer. The only variation being that in real life, sometimes it will have a small wick at the top, right? You find that very, very often. So in this case, again, note this. This is a pin bar. When we look at pin bars, we don't care about the color of the body. We basically don't care about the color of the body. This candlestick here is called a bullish pin bar, even if the color is bearish. Even if the coloration for the body is bearish, it will still be called a bullish pin bar. Why will it still be called a bullish pin bar? Because it's simply, you have long wick to the downside. When you have a long wick to the downside, it means there were lots of buying orders sitting here. Price fell very, very wonderfully. And when it hits that buy order, boom, price shot up, right? The orders were activated. So it's simply telling you that there are buyers in the wick. It's simply telling you that there are buyers in the wick. And that's why it's called a bullish pin bar, right? We don't care about the color, right? For it to be a bullish pin bar, by my own personal definition, I expect that the wick should be at least 2, if not 3 times larger than the body. The tail or the lower wick should be 2 or 3 times greater than the upper wick and 2 or 3 times greater than the body. Again, the color of the candlestick pattern doesn't matter. Now, even though we say this is a bullish scenario, right, we are still indecisive. It's still an indecision, right? So what do we do when we find a bullish pin bar? We basically box it out again, and then we wait for price to break above and close for us to be bullish. And if price breaks beneath, it means there were some sellers came in and the buyers here were annihilated, right? So we want to be sure that the buyers actually took off and took off well. I am aware that there are some other strategies that will help you pick the tops and the bottoms. We'll discuss, we'll touch on them briefly as it relates to AQZ, maybe on Wednesday or so. But for now, just know that this is an indecision candle. You want for price to break. And when price close above, just like with a bullish engulfing candle, you could either go in for your long at the close of the candle or wait for price to come back to your box. In this case, that point. So those of you trading AQZ already, you're already seeing what the box is all about. When you have your PE somewhere there, she's talking about the same thing. right? We're just laying foundation so that newbies can understand what we're saying. So again, we're done with that. That is the opposite of the bullish pin bar is called a shooting star. Basically, just call it a bearish pin bar. Just a bearish pin bar. And it's basically the opposite of a bullish pin bar. So we don't need to explain this again. Let's move on. Now, the next candlestick pattern we'll be discussing is called the Harami pattern, and that is the almighty inside bar, right? So an inside bar is like a pregnant woman, right? So here is the head of the woman. Here is her tummy, and these are her legs, right? So basically, it's just a pregnant woman, right? So, but this means her neck must be so long, but no problem. It's cartoon. So let's move on. So for an inside bar, it's like the flip side of an engulfing. For an engulfing, you have the larger candle to the right. But for an inside bar, you have the smaller candle to the right. Right? So this will be a bearish engulfing. But this is an inside bar. Inside bar. Right? When we have a bullish candle inside a large bearish candle, we'll call it a bullish inside bar. And of course, the opposite is true for a bearish inside bar. Again, an inside bar is a sign of indecision because price prints from the left to the right. You have a bullish candle, 4 hours, and large, very large candle, 4 hours. You should expect that if the bullishness here is genuine, the next candle should still be bullish. But then, lo and behold, it turned out to be a bearish candle, even though a smaller one. Well, you should be interested in waiting to see what happens thereafter. So what happened to all the buyers here? Where are they? You should be interested in waiting. So it's an indecision candle for both a bearish and a bullish inside bar. We would want to wait, again, box it up and see what price will do. If price closes above, then we are interested in continuing our longs. And if price comes and closes beneath, then it means that the buyers here again have been annihilated. Right, so let's move on. So when you find a bullish inside bar like this in price action, say you're trading support up there, resistance up there, and support somewhere here, and price trades straight into a support, then or supply and demand, whichever one you want to call it, or it could even be a trend line, and price trades into it, and you see a bounce, you should box out this candle and wait to see what happens. If price closes above it, whoop, you are going in for your buy. Your entry could be at the top there, but sweeter if it comes to the body. Again, AQZ will give us a very sweet entry at the preferred entry. So anywhere within that point, we are basically buyers, right? Again, inside bar. Notice if you had, again, another inside bar at the topmost part. Here we have a bullish inside bar, and here we have a bearish inside bar. Notice that 1, 2 very large candles, 1, 2, as if the buyers were just skyrocketing to the moon. And all of a sudden, you find a bearish candle somewhere there. It's like the buyers are not too confident, or somehow the buying pressure has been sucked up by a very strong selling pressure somewhere there. You would want to box out this candle and basically wait to see what happens. If price closes, then you take a sell from that point and you go down. Right? Basic candlestick patterns, right? So let nobody come bobo us with some big terms, and it's now making us feel like we have to bow to one big language there. Right? So with AQZ and basic candlesticks, we're good to go with any strategy. This is the last one we're going to discuss, and it's called a tweezer. A tweezer, also known as a railroad in some texts, is basically what I call return to origin, right? So sellers came in, pushed price down to this point, buyers came back, pushed price up to where sellers came back from. And that was also price came back to exactly the same spot it came from. So if this were if this was a 12-hour candle and this was a 12-hour candle, at the end of that day, you basically have a doji, right? Price returned back exactly to where it opened from. So it started from above and pushed down, then came back and went back and closed almost at the same point. It's basically a doji. And remember, when we're defining doji, we said it doesn't have to be an exact price. You might have some, difference in the way in the close and open, but basically the size is almost the same thing. Again, when you find a tweezer where sellers sold massively or whatever the distance, and buyers came back and pushed it to, an area that is similar, it's just wise to sit down on your hands and wait to see who will take preeminence. If buyers pushed up and you are in a buy zone, let's say a H4PC, or I won't use those terms, we're assuming that nobody understands what the PC is for now, then we'll be going long. And if you were anticipating a sell before now, and a candle it finally closes beneath, now you're confident that the sellers eventually won this tug of war, and then you'll be thinking of going bearish. All right, so somebody's asking if we can hear the audio. Not too sure if we give that person. All right, so let's move on. So we have a tweezer bottom meaning that the last candle started from beneath and pushed up, right? A top, the last candle started from the top and pushed down. Basically, that's just it. So these are the top and these are the bottom. Again, it's an indecision candle. So let's wrap up this candlestick story. So in the candlestick story we discussed, we covered basically 4 candlestick patterns. We had the engulfing candlestick pattern, which we say is the take action now candlestick. And then we covered the doji, we covered the pin bar, we covered the tweezer. I think that was all we covered. The engulfing had 2 parts. It was either bullish or bearish. These other ones, yeah, the hammer could be bullish or bearish, but we don't care about that. These other ones are indecision candles. We wait to see what price will do. A bullish engulfing or bearish engulfing candles on their own have already told us what we should do. We will either want to get aggressive and enter the close of the engulfer, or we'll wait for a pullback to cover the bridge, and then we'll take our trade. All right. So that's basically, so here we have a tweezer. What do? We box it up and wait for, candlestick pattern to show us that we're basically bullish. We could enter for a buy here or wait for price to pull back, and then we run, right? Again, why are we discussing candlesticks? There is no way, practically no way, for a retail trader, I'm not talking about institutional traders, they may have some database, they may have some sophisticated indicators that give them certain stuff. But for retail traders, there's practically no way I could be trading here in Nigeria and know what trade you want to put up in South Africa or California or wherever you are upon the face of the globe. Except, of course, you believe the earth is flat. Then upon the face of the plane. There's practically no way I could know that, right? So the only way I would be able to know the collective reaction of everybody is by seeing candlesticks and interpreting it appropriately. Now, that may mean that my entries may not be precise to the pip, meaning that I might not be able to enter bullish from that low, or I might, but once in a while, not very often, but I could very often take a trade off this region after certain candlestick patterns have formed, and I'll be profitable nevertheless, right? So those are basic candlestick patterns. You should watch this video to be able to know them. So here we have an an inside bar. Here we have a tweezer. Here we have something that looks like an engulfing candlestick pattern. Here we have an engulfing. Number 4. What do we call that? What do we call number 6? And number 7, we call that an inside bar. Right? So let's move on. Okay, so we're done with this. Let's go straight into AQZ qualifying candles, and then when we come back tomorrow, we'll discuss structure and start piecing them together. Right? Last thing we discussed today quickly in the next few minutes we'll have is AQZ qualifying candles. So when we discuss AQZ, we're looking at basically engulfers. That's what we're looking for, engulfers. Now remember, the engulfers can either be the normal engulfing or the inside bar, right? So in this case, first candlestick pattern you have here is a bearish engulfing candle. And it's dominating, the bear candle dominates the bullish candle, right? Now, here we have a bullish engulfing telling us that buyers are in control. Remember, we could have gotten in for a buy from this level or waited for price to come back to this level. But when price came back and broke this level, it simply means that all of the buy pressure here had been absorbed by sellers. And we call this a violated bullish engulfing, right? So we're introducing some other terms we discussed earlier. Let me share a new page. And we'll wrap up now in like about 5 minutes. It's a 5 days program, so we'll not make each day long. So we said usually we'll have, let's say, a bearish engulfing like this. So we had a bullish candle going all the way up. Then the bears came and pushed it down. We would have been anticipating sales from this level or waiting for price to come, close the bridge, and then drop. That is a sign for sell. However, if for any reason we then have another bullish candle come and close above this level, not necessarily one candle, it could be series of candles coming to close above the bearish candle, we say that the bears have been violated. We say that this bearish pressure has been absorbed, and therefore the bears have been violated, right? The same thing with every other candlestick pattern we discussed before now. So if you have a bullish candle, it could be violated, an inside bar could be violated, and every other candlestick pattern could be violated. So we'll stop here for today. So it doesn't get too long. It's a 5 days program. Like I mentioned earlier, we would cover every single thing here. For those of you who are, experienced traders, you should be interested in seeing what we will cover here. Right? Liquidity spread yield as drivers of price. You should be interested in what we'll cover there. For those of you who want to just trade, take your money and run away, you should be interested in what we'll be doing when we get to scalping. And if you're swing traders, well, AQZ has you covered, right? So today we just discussed candlestick patterns. Every single thing we'll be doing will be based on candlestick patterns. Our indicators could tell us to go bullish, which is one reason why we love the AQZ. So let's say you're using the H4PC and the H4PC say go bullish. And the candlestick, which is what shows us the cumulative reaction, fear, greed, and sentiments of the big guys. If the candlestick tells us the PC is wrong. We simply forget about the PC and trade price action. So even though we say we have indicators, we're basically trading price action, which is why we had to take time to go through this in